In this video, we're going to talk about what a 1031 exchange is and how you can benefit from it if you own real estate. So hit that subscribe button and turn on that notification bell so you stay up to date on when new videos come out. If you're thinking of selling a piece of property that could result in a big profit and a big tax bill, a 1031 exchange could be a useful strategy. So what is a 1031 exchange? A 1031 exchange, named after Section 1031 of the US Internal Revenue Code, is a way to postpone capital gains tax on the sale of a business or investment property by using the proceeds to buy a similar, like-kind property. So then how does a 1031 exchange work? A 1031 exchange can be complex, so you'll likely have to consult with a qualified tax pro. You can read the rules and details in IRS Publication 544, but here are some basics about how a 1031 exchange works and how the steps are involved. Step 1. Identify the property you want to sell. A 1031 exchange is generally only for businesses or investment properties. Property for personal use, like your primary residence or vacation home, typically doesn't count. Step 2. Identify the property you want to buy. The property you're selling and the property you're buying have to be like-kind, which means they're of the same nature, character, or class, but not necessarily the same quality or grade. Note that property inside the US isn't considered like-kind to property outside the US. Step 3. Choose a qualified intermediary. If you don't receive any proceeds from the sale, there's no income to tax. That's generally the idea behind the 1031 exchange. One way to make sure you don't receive cash prematurely is to work with a qualified intermediary, sometimes called an exchange facilitator. Basically, they hold the funds in an escrow for you until the exchange is completed, assuming the sale and the purchase don't take place simultaneously. Choose carefully. If they go bankrupt or flake on you, you could lose money. You could also miss key deadlines and end up paying taxes now rather than later. Step 4. Decide how much of the sale proceeds will go towards a new property. You don't have to reinvest all of the sales proceeds in a like-kind property. Generally, you can defer capital gains tax only on the portion you reinvest, so if you keep some of the proceeds, you might end up paying some capital gains tax now. Step 5. Keep an eye on the calendar. For the most part, you may have to meet 2 deadlines or the gains on the sale of your property may be taxed. First, you have 45 days from the date you sell your property to identify potential replacement properties. You have to do that in writing and share it with the seller of your qualified intermediary. Second, you have to buy the new property no later than 180 days after you sell your old property or after your tax return is due, whichever is earlier. Step 6. Be careful about where the money is. Remember, the whole idea behind a 1031 exchange is that if you didn't receive any proceeds from the sale, there's no income to tax. So taking control of the cash or other proceeds before the exchange is done may disqualify the deal and make your gain immediately taxable. Step 7. Tell the IRS about your transaction. You'll likely need to file IRS Form 8824 with your tax return. That form is where you describe the properties, provide a timeline, explain who was involved, and detail the money involved. So let's talk about the notable rules, qualifications, and requirements for a 1031 exchange. You still have to pay tax, just later. A 1031 exchange doesn't make capital gains tax go away, it just postpones it. A capital gains tax bill will come due at some point, so prepare for that. Not everyone is eligible. A key rule about the 1031 exchange is that they're generally only for business or investment properties. Property for personal use typically doesn't count. Also, securities or financial instruments aren't usually eligible for 1031 exchanges. This includes inventory, stocks, bonds, securities, debt instruments, partnership interests, and certificate of trust. The properties don't have to be as similar as you may think. You don't necessarily have to swap a rental property for an identical rental property or a parking lot for a parking lot. Like-kind general means you're swapping one investment property for another investment property. Again, be sure to see a qualified tax pro before you're taking action. It might be possible to exchange vacant land for a commercial building, for example. Next, you're not limited to buildings or land. Real estate isn't the only kind of property eligible for 1031 exchanges. Personal property, which includes such items as cars or trucks, may be eligible. You just can't exchange real property for personal property. They're not like-kind. Finally, relationships matter. Your qualified intermediary or exchange facilitator can't be a relative, your attorney, banker, employee, accountant, or real estate agent. People who have served you in any of those capacities in the past 2 years are also off limits, and you can't be your own qualified intermediary. So let's talk about types of 1031 exchanges. First is a simultaneous exchange. In a simultaneous exchange, the buyer and the seller exchange properties at the same time. Next is the deferred exchange or delayed exchange. In a deferred exchange, the buyer and the seller exchange properties at different times. However, the sale of one property and the purchase of the other property have to be mutually dependent parts of an integrated transaction. The rules here can get particularly complex, so see a tax professional for that. Third is a reverse exchange. In a reverse exchange, you buy the new property before you sell the old property. Sometimes this involves an exchange accommodation title holder who holds a new property for no more than 180 days while the sale of the old property takes place. Again, the rules are complex, so see a tax pro. And finally, you need to watch out for 1031 exchange scams. I'll talk about this in another video. The IRS permits 1031 exchanges, but someone promoting them might have ulterior motives if they tell you to exchange vacation homes or that the deal is tax-free. It's actually not, it's tax-deferred. So what are your thoughts? Are you thinking about getting a 1031 exchange? Are you in the process of doing it? Leave a comment down below and let's get a discussion started. And as always, take care of your money. I recently finished Money Honey by Rachael Richards, and I included in this video as a way for you to expand your financial education outside of this channel. I'll leave a link to the book down below, and if you prefer listening to it on an audiobook for free, I'll also leave a link to a 30-day free trial to Audible. You can choose this book or any book to listen to, and even if you cancel before your free trial is over, you can still keep the book and listen to it whenever you want. Oh, and one last thing before you go. I created a course called Smart Money Parenting as a way to teach parents how to educate their kids about money. An early financial education is the foundation for wealth building, so give your kids a future they deserve. Use code MONEY20 at checkout to receive 20% off my master course. I'll leave a link to the course down below.